All right, good afternoon, Investment Committee. We're super excited to be here to show you our analysis of the Northern Lakewood investment opportunity. It seems like our investment committee has grown a little bit, so for those of you that are new, we'd like to introduce you to our team. My name is Theo. This is Andrew, Daniel, Melissa, Kaylee, and Tyler, and together we form DB Realty Capital. It's really great to be here, and just to make sure that everyone is on the same page, we'd like to just take a quick overview of the investment opportunity. So if I'm going to break the investment opportunity down into three major components, I would like to say that there's the big size of the opportunity, there is the subsidy, and there is a strategy. And so for the size, we have access to 1,000 units of multifamily housing located in an urban area. The purchase price is about $460 million at a 4.87 cap rate. And we have the opportunity here to place just under $100 million of our own capital. So it's a pretty remarkable size. The second piece is subsidy. So our operating partner, 512, has negotiated an agreement with the city of Lakewood, which allows us to, in exchange for creating some affordable housing, to take advantage of two significant tax benefits: an 85% reduction in our real estate operating taxes annually, as well as a $6 million transfer tax credit. Both of these are substantial, and as we will later show in our analysis, provide a significant bump to our bottom line. The final piece is strategy. We are in the late stages of the cycle, and so our strategy doesn't rely on rent growth or cap rate depression in order to achieve the goals we are looking for. We're more looking to realize gains on CapEx and also gains from the agreement with the city. When we talk about our strategies, we are mainly going to focus on strategy number one, which is pursuing the agreement with the city of Lakewood. But we are also considering strategy number two, where we decide to turn down the opportunity with the city of Lakewood and convert fully to market rate units. Also, just a quick update on our fund. So far, we have been able to invest about $425 million of our $850 million, mostly in value add and core plus office properties. We're seeing some pretty great returns from those. We're looking just north of 15% IRRs. In addition to that, what we're really looking for is a little bit of asset class diversification. We're looking at opportunities to place the remainder of our capital in a slightly less risky asset. So I'm going to turn it over to Andrew.
So with that in mind, we wanted to think about the positives as well as the negative considerations of this investment, as well as the market this investment is located in. So some of the positives around this investment are mainly focused around the asset class itself, affordable housing. This gives, it's a very defensive asset class. It gives us diversity in our investment, and it also gives us a phenomenal tax advantage that we mentioned earlier. The downside of affordable housing is that the rent increases are limited, and for this investment specifically, we also need to put in a lot of capital and are coming in at a core cap rate. The positives for the market itself is that the neighborhood is great. It's growing in both population as well as job prospects, and the restricted housing in that neighborhood sets up a barriers to entry for other competitors to come in. The negatives for the market are focused mainly around where we are in the cycle. So we're late in the cycle. There's a lot of uncertainty around cap rate expansion and rate increases as well. So before we dive into our recommendation, we also want to talk about some of the high-level themes we've seen and how these are driving our decisions. The first is the broad global theme of urbanization. So over half of the global population currently lives in urban areas, and we're expecting that to increase by 2050 pretty significantly. For North America specifically, this is over 80%, and we're seeing growth there as well. While there is a significant positive with this around virtuous cycle with cities, so more people want to move in, live in those cities with the larger tax base, cities look more appealing and more people come in. We also see some pretty big negatives with this too, the biggest being essentially affordable housing and affordability in rent. So if you look at the bar graph, it's essentially showing the amount of cost-burdened renters and that it's steadily increased in the last 20 years. A big reason for this is the bottom line graph, essentially showing that wage growth hasn't kept up with rent growth. So that dark blue line is rent growth in the last 50 years. It's steadily increased. wage growth has kind of stagnated at about 0%. With these big issues and concerns, we've also seen the public sector and governments think about how to resolve this, as well as some private companies. And I'll let Daniel talk a little bit more about the government.
And based on what Andrew just said, higher rents lead to a stronger debate around rent control. 5 states in the US already have rent control laws, and we saw that this year just Oregon and California have passed statewide rent control laws, and New York City has made it more strict. When we look at the 2020 presidential candidates, we see that some of them defend national rent control laws. And we also brought here on the bottom right some examples of cities that have restrictions on MCI, or major capital improvements, and also annual rent increases. We also found it interesting to bring to this discussion the case study of Peter Cooper Village and Stuytown. Are you all familiar with Stuytown? So 2 main lessons that we took away from this case study, and we think it's applicable to the deal we are analyzing here, is that first, converting apartments to market rate apartments, it's risky, as happened with Tishman Speyer in 2006 when they acquired the property. There was this major backlash. They ended up returning the property to the creditors. And the second takeaway was that when Blackstone came in, that the city of New York just changed the rules and limited to 2% of MCI that they can pass through to tenants. So they're reviewing their strategy, they're analyzing, and they put any kind of capital improvements on hold. And I'll pass to Melissa, who's going to talk about other major trends.
Great. So I'm going to talk a little bit about what private companies are doing around the urbanization trend that we mentioned and the affordable housing lack of supply. So we see that companies are kind of focusing on micro units. Those are those apartments that are about 350 square feet. We see that the occupancy for those apartments in the US is greater than the occupancy rate for larger apartments. And then moving on to co-living, we see Common and Hub House starting up and creating these co-living spaces, which is where you might have a private space, but then you share a kitchen, et cetera, with your neighbors. And we see that that is particularly interesting in Europe, where real estate investors are ranking it about 4.5 out of 5 in terms of how interested they are in that investment. And then moving on to apartment hotels, this kind of ranges a broad spectrum of different types of apartment hotels. But we can think about the Guild as an example in that space here in Austin, and they lease out spaces in apartment buildings and then rent those units to your typical hotel guests. So those hotel guests have access to the city, to the urban center, and are typically staying for a little bit longer of stays. And we see that the occupancy rate for those are a little bit higher than the typical occupancy rate for hotels in the UK. So again, these are a little bit bigger. The last 2 are a little bit bigger in Europe. And they're interesting trends that we don't think are right for our portfolio right now based on the risk profile of them, but something that we want to continue to follow and see what effect they have on affordable housing moving forward. The next comment I just want to bring up is how tech companies are noticing the lack of supply of affordable housing in the market and are addressing that, particularly when they're located in these urban areas that are seeing that rent growth. So Apple, for example, is contributing $2.5 billion into the affordable housing crisis, and that's through a variety of different things, including leasing land. So we talked a little bit about some of the benefits to the fund and some of the social benefits. I just want to highlight a few here. For the fund, it's the tax benefits, so taking that tax rate from 20% to 3% for the affordable units being included. It's a low risk in terms of a recession. And then because of the relative safety, we're able to increase our leverage and realize that return. And then from the social benefit side, of course, the affordable housing supply that I mentioned. And then with the affordable housing, adding more supply allows more middle-class workers to be in the urban areas and really contribute to the economy and help grow the economy of those urban areas. And then lastly, it being an ESG investment really appeals to some of our investors as they're looking to continue to add that to their portfolios. So I'm going to turn it over to Kaylee to talk a little bit more about our particular recommendation.
Great. So Theo touched on this a bit, but we are looking to move forward with the affordable housing units that the city brought to us, and we will be partnering with 512 to do this. So we will be turning over 2/3 of the current units to affordable housing. So we are assuming that 15% of the market rent units will be turning over year over year, and 3.5% of the public voucher units will be turning over year over year. So we will be converting those to affordable units. We will be leaving 60% of the current market rate units as market rates. We'll be having 1/3 market rate units and 2/3 affordable housing units in the building. So with that, we are seeing a 7.41% IRR unlevered and a 1.41 times MOIC. We are also looking to invest 75% LTV in our property. We think with the low interest rates, we would like to take advantage of that. And something I will also talk about in a bit is our ESG investments that are also going to reduce our interest rates by 25 basis points. So with that, we think it's a pretty safe investment to lever on 70%. And this will lead us to a 14.51% IRR and a 1.93 times multiple. We do think that this is a pretty safe investment and the best investment we could move forward with. This will leave us with a pretty high debt service ratio coverage, so that's something that's really important to us. So the two other additional capital improvements, in addition to increasing the in addition to renovating the market units, are a cogeneration plant and utility submetering. So the cogeneration plant will be a $1.7 million investment or $7.5 million investment over the first 2 years, and it will give us $350,000 worth of savings year over year. As I said, this is also reducing our interest rate by 25 basis points, so it is giving us $800,000 worth of interest rate savings, which is great. The next one is utility submetering, which is really bringing the utility charges and just getting reimbursements from the tenants. So this is going to be a $2.8 million investment year over year and a $1.7 million worth of savings year over year. The $2.8 million will be invested in the first 2 years. So the two things that are really important about this are that both of them have ESG benefits, which we think are really important for the current building, the current environment, and it's also very important for the next buyer to have this ESG benefits into our building. The other really important and great thing is that these two capital improvements will help increase our IRR by around 420 basis points. So two big assumptions that we put in was that we were going to exit at a 4.75 cap, and that when we do these renovations, we will be able to increase the market rent and the public voucher rent to get a 10% return on our ROI for market rent and 15% ROI on public voucher. So those are the two big assumptions that we wanted to sensitize because we knew that those are risky assumptions. The first one, if you look from left to right, you can see the effect that not getting the full 100% of the forecasted premium of the renovated units. That did not move the needle as much as the IRR, as much as the cap rate is going to move the needle, but we do see that it will affect it. But even if we go in and have 0% premium but stay at a good cap rate, we can still exit at a pretty good core IRR. The next thing that was really important to sensitize was the exit cap. So we are assuming that we are going to be exiting at a 4.75 cap. But if you look up and down, you can really see that that does move the needle, and that will really affect our exit price and our IRR. Something that we think is a good buffer to this is we don't think that the interest rates are actually going to increase 75 basis points because the last time that has happened was 2009, and we just don't think the recession is going to be that bad. With that, we do have 2 extensions in our fund. So if it does get to that, we will hold it for a couple more years and sell it then. So we wanted to model the downside case to really see where we would be exiting if all these things did happen, and you can see those in red that our returns are not that bad and we want to continue to stay in. I'm now going to pass it over to Tyler, and he's going to walk us through our pref and promote structure with 512.
Thank you, Keely. So now that we've mentioned that we really do like this investment and would like to move forward, we need to discuss the terms of our proposed joint venture with the operating partner 512. So as you may recall, 512 has been asking for roughly a 50-50 split of the equity, a say in all major decisions pertaining to the project, and then also additional economics to compensate the heavy lift that they'll have to put in to actually renovate these units, and then also the effort that they've put in to identify this opportunity and work with the city. So certainly we do agree with them. We understand where they're coming from, but we want to make sure that we're structuring this joint venture so that it is beneficial for them, but is also the type of investment that we really see fitting best with our fund. So what we've proposed is, from an equity perspective, a 60-40 split, 60% of the equity coming from our Mosaic 5 fund, and then 40% coming from 512. That's not exactly the 50-50 split that they've requested, but we think that due to the attractiveness of this opportunity, the stage of where we are in our investment period, and then the opportunity for us to really fit this in with our fund, when this is such a key piece and such a great fit for where our fund objectives are and our performance are right now, we think that the additional capital spend is definitely justified. So moving on to the other terms, decision authority, we would like for 512 to have a seat at the table, and so we are proposing that all major decisions must be approved by the mutual consent of the partnership, and then also to compensate them as the project goes, we're proposing a 1.5% acquisition fee, and then also a 1% annual asset management fee, 1% of the committed capital to the project to help them continue funding their operations as they support this project. Which brings us to the next point of the joint venture, which is the waterfall. So again here, we thought about what our objectives were. Our objectives to protect our downside and really make this a safe investment for our fund to help make sure that we stay within that 12 to 14% IRR range. But we do understand the need to compensate 512 on the upside in exchange for that. So what we've proposed is a 9% pref to Mosaic 5, a 9% catch-up to 512, pari passu split all the way up to a 12% return on the project, and then an 80-20 split thereafter in favor of 512. So the next thing we've done here is shown how that waterfall would play out over a variety of returns or a variety of scenarios for the project. So beginning with our base case here, and you'll see that's a 14.09 IRR, slightly different than what Kaylee mentioned previously. That now factors in the proposed asset management fee. And under that scenario, Mosaic is realizing a return of 12.75%, while 512 is getting that additional upside and is almost seeing a return of 17%. What's important to note here is that we also modeled out that downside case where we see the cap rate go up to a 5, we don't get the full premium on the units that we renovate, and we are still seeing a 9% return to Mosaic 5. So we think this scenario, or this proposal rather, really provides us that downside security to make sure that this fits well within our fund and helps us track to our goals, but also gives 512 that additional upside to motivate them to really try to exceed that 12% return and get their outsized portion of the proceeds. And so while we have talked about this being a relatively safe investment, that's not to say that it's without risks. So as we talked about the sensitivities, cap rates are certainly a concern here. A shift in cap rate can have a very dramatic return on our project returns, but we think given the quality of this market that we really aren't going to see that shift of 75 basis points that we modeled in our sensitivities. Which brings us to the next risk, which is rent control laws. So we talked about the variety of ways that can present itself, but certainly as we saw in the sensitivities, we are not that sensitive in terms of returns to the premium that we were able to charge on the units. Certainly if we were capped, it would hurt returns, but it's not gonna hurt returns badly enough to make this a bad investment. While, or shifting rather to the pure rent control laws, so just increasing on rents year over year, that's not necessarily a concern for us because we've underwritten rent growth of only 2.5% to 3% on units, and that would not necessarily be impacted by rent control laws. So we also talked about recession already, but moving down to agency conflict, we think that the proposed waterfall structure will really align the incentives between ourselves and 512. And then we're also optimistic that 512, as a local player in the market, is going to be extremely motivated to make sure that this project goes well. Their name is going to be very much attached to it, just like ours, and we're confident that they'll want to make sure that this is a success. The last thing we want to discuss in our remaining time is the market rate scenario that Theo discussed at the beginning of our presentation. So we felt that our due diligence would be incomplete without evaluating this. And so this scenario would entail us converting any units that are vacating to market rate and foregoing the tax abatement provided by the city. And as you can see here, our returns, unlevered and levered, are relatively similar to what we saw in our base case, but the risks are certainly much higher. There's certainly the legal and PR risks that we talked about with the Stuytown case, and then also the risk that rent control could impact our returns, and then lastly, the fact that from an ESG perspective, our investors might see this as a very much a negative. And so in conclusion, we're recommending that we go with the proposed plan with the city, that we use 70% leverage, partner with 512, a 60-40 equity split, and follow the waterfall that we detailed in these slides. And so with that, we'll open it up to questions. Sure, so if I understand your question correctly, major tiebreakers around questions of liquidity, so like at disposition, if there's a disagreement about whether one party would like to sell and the other would not. And that's actually something that we had discussed earlier today with the smaller group. We think that there would certainly need to be additional language beyond just mutual consent of the partners in the event of a disposition, perhaps a clause where we could buy out the stake of 512 and sell the asset, just guaranteeing them some sort of return, or perhaps like a reverse shotgun type setup. So that could take a variety of forms, but would be something that we would need to consider further. So 512's numbers certainly in the very bad, like very downside cases, did not look as good as ours did. But we also were considering that 512 is going to get that upfront acquisition fee and then the ongoing asset management fee. So while their returns wouldn't necessarily take the form of project cash flows, they're still getting compensated throughout the life of the project.
Yes, and we also, that's part of why we put the upside as well, because it's sort of a balance between they get all the upside risk and we'll get more of the downside risk, but they are protected enough on the downside that they're going to want to move into the project.
Well, that's an interesting point. I think that we honestly aren't that far apart from them on terms, right? So if they wanted 50%, if they wanted that 50-50 split, we could certainly do that. If they wanted to do 8% instead of 9%, right? We could definitely have that conversation. But I just don't feel like we are so far apart on terms that we wouldn't be able to get there. But I don't think we would want to give up everything, because certainly, we do want to protect ourselves. And so really the key thing I think for us is being in that first position to get ourselves to like a 9 or an 8, and then hopefully get ourselves to the 12, to the low end of our fund target.
And adding to that, yeah, we would let them know. We would let them know that if they want to split 50-50, we would either not give them the upside or do a 60-40 split on the upside where we get 40, or just do a power pursuit split after the entire time.
All right, thank you.
Thank you.